Perfect. So I see a lot of familiar names in here, so hello to everybody. We're going to be talking today about how to trade like a hedge fund manager, and I know that that's kind of a cryptic and mysterious title for a presentation, but we're actually going to be talking about how I, as a retail trader, because I'm a retail trader, just like all the rest of you guys, I use thinkorswim as my main platform for executing trades. I only use tools in thinkorswim and charting in thinkorswim. So I'm using the same things that you guys have access to. I'm a retail trader just like the rest of you. I'm not using any kind of super high latency data feeds or anything like that. But we're going to talk about how I can use the trades and orders being conducted by big hedge funds and big institutional traders to get a better gauge on where the market is going to be moving and where momentum is in the market at any given time. So before I get started, I do want to read our standard boilerplate risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings and are generally not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades or recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Please contact your broker or registered investment advisor for execution margin and all other capital requirement questions. Everyone watching this presentation adheres to all disclaimers on optionhacker.com and alphashark.com. I'm getting to the point where I can do that in one breath, but not quite. So I'm not going to talk too much about myself because everything was pretty much said already. My name is James Ramelli. I'm a trader here at alphashark.com. I'm also our head options educator, regularly on CNBC, Bloomberg, Fox Business, BNN Canada. Maybe you've seen me on TV. If you haven't, you might have read something that I've written. I write for CME, Open Markets, Futures Magazine, Active Trader, some of these other names, and a number of other online publications as well. So enough about me. I want to talk about why we're here today. So the problem we're trying to solve is kind of the gap in success between retail traders and institutional traders. 90% of retail traders lose money in the long run. Why is that? When most institutions make money, right? And it's because of inherent advantages that they have and things that are very difficult for the retail trader to compete with when we're talking about institutions that have just vast pools of capital and resources at their fingertips that we can't ever really hope to access ourselves. Now, I have been told that perhaps this statistic is a little bit different now, that it's something more like 80% of retail traders are losing money in the long run. But what that tells us is that the vast majority of traders that try to trade equity options actively as a retail trader are not going to be successful. Yet there's institutions out there that haven't had a single losing trading day in the past 5 years. Right? There's several shops like that here in Chicago. So we have to ask ourselves, what is it that makes them so much better? Are they really that much smarter than everyone, or are there some advantages that they have over the rest of the trading public and the rest of the market participants that don't have access to all of that capital that they do? So this is where our trading plan comes in with the whole concept of trying to trade like hedge fund managers. I want to be able to trade like these guys without having all of that capital. They have advantages. They do well. They are worth as much money as they are for a reason, because they are successful in the long run. Some of them might have bad years, they might have bad months, they might have bad quarters, but overall they are successful traders. And this is where unusual options activity comes into play. If you haven't figured out, that's what we're going to be talking about today, is unusual options activity. And there's a reason that we care about unusual options activity. Unusual options activity gives us a window into institutional order flow. And simply put, unusual options activity is orders taking place in the equity options market at a multiple over the average daily volume in the equity options market for that particular symbol. So for example, if stock XYZ trades 1,000 options a day, and I see an order coming in for a trader buying 10,000 calls in stock XYZ, that is an unusual options activity trade. It's unusually large relative to the average daily volume in that stock. And these orders, because of the size and the amount of capital that it takes to control positions that big, we know that they're coming from institutional traders. Hedge funds, mutual funds, sovereign wealth funds, big banks, or big individual traders who have access to a whole lot more capital than I do. And it lets me, as a retail trader, see where the smart money is going, see where the big institutional money is placing their bets on a daily basis, where they're getting long, where they're getting short, and what it is that they're expecting to move or break out at any given time. Now, there's reasons that we care about this unusual options activity, and it's all because of the advantages that these institutions have that we can't compete with on our own. And it all starts with capital. They have so much more capital to work with than I do, than you do, than probably all of us do combined in here at a multiple, right? And this capital drives their advantages in these other areas, right? They afford more manpower, they afford better technology, and they have access to information that we don't have. Who here thinks, and this is a really quick poll, who here thinks that institutional traders, meaning the biggest traders in the world at the highest level of market participation, never, ever, ever use insider information or commit anything that is against regulations that the SEC or FINRA lays forward? Does anyone think that it never happens, that insider trading doesn't happen on the institutional level, that they're all playing by the rules all the time? If you agree with that statement, let me know. I don't think anyone is going to answer yes to that. Yeah, it happens, right? Usually people respond to that with like a laugh out loud, right? It happens all the time. We hear about it happening all the time. And if you watch unusual options activity, you would be shocked at just how often it happens without any mention of it on financial media, in the news, or anything like that. It happens on a daily basis. But let's assume for 1 second that they don't do any insider trading. They don't execute trades with information they're not supposed to have. Do we still care about their order flow if that's the case? And the answer is absolutely, because they have access to all these other advantages that we don't, right? How many hours a week do you guys spend outside of market hours doing research, meaning reading articles about stocks that you're trading, looking at financial statements, looking at charts, reading earnings reports, sitting on earnings calls? How many hours on average do you guys think you spend a week? Is it 10 hours? Is it 15? Is it 20? Some people say they spend as many as 30 to 40 hours a week outside of market hours doing that type of research. An hour a day, 10 hours, 20 hours. Yeah, so I mean, that's really good. You guys are spending a lot of time on that stuff, right? But unfortunately, you as one person are never, ever, ever going to be able to spend as much time doing analysis and doing research on the public sphere of information as a team of quants at a hedge fund are going to be able to do. They just have access to more manpower. So even their analysis of the publicly available information is going to be at a higher level than what I can hope to compete with. I'm one person. I don't have an extra 100 hours a week to spend doing analysis and doing research. I'm never going to be able to consume all of the information available out there on a particular position or on a particular thesis that I might have on the market, right? So it kind of seems that once we add back in the idea that they do have insider information that they trade with sometimes, that we can never really hope to compete with this hedge fund machine, right? But if we're able to get the end result of all this work, which is their trades, then it doesn't matter that I don't have these advantages. All I'm trying to do is pick out the end result, and it's always going to be a trade. And because markets are publicly regulated institutions, we know that we're going to be able to see the order flow in the equity options market being conducted by these institutional traders. And this is where we enter into the world of reading the tape and reading unusual options activity. And this works in options rather than the stock because, unfortunately, trying to track money flow in stock is almost like a useless endeavor, right? Dark pools exist for big institutional traders to transact stock with each other off of the exchange, hiding their price action and order flow from the rest of us. This means that we can never really get a good sense of where the institutional money is flowing if we're only looking at stocks. Because at the end of the day, when we see the total volume traded on the NYSE, on the NASDAQ, on the BATS, on any exchange, it's only a fraction of what the total volume of the day was. Most of it takes place between institutional traders in these dark pools. But they don't have the ability to do that with options. So let's talk a little bit about that. As soon as they come up with an idea, either based on all this research that they've done or a tip that they got in the clubhouse at the country club this weekend, they're going to come up with an order based on research, information, analysis, or something else, right? They call up their broker. to get that trade executed. They shop it around all over the place. It has a bunch of different ways that it can get filled, either on the floor, in a trading desk, or by the broker themselves. But what's important to understand is that at no point throughout this process do they have the ability to send this order off to a dark pool. If it is an options trade, it cannot be filled in a dark pool, and it will be filled on a public exchange. So the CBOE, I apologize for my handwriting, the NYSE, the PhilX, the BSX, etc., etc. If the order is filled on one of these exchanges, the exchange has to report to the rest of the trading public, meaning us, all the pertinent details surrounding this trade, okay? So that means that we're able to see everything that we need to see about this trade as soon as it's conducted. They can't hide their order flow in the equity options market. So this is what we end up with. Is a window into the buying and selling that is happening in the options market by big institutional money. Now, don't get too hung up on the format of what you see here. This information is going to be available from a number of sources. You can get this in Thinkorswim. You can get this in TradeStation. This is just how it looks on a piece of software that we use to track order flow. But all this other info is going to be available in any place that you can see time and sales, because they have to tell you all of this stuff. And we're able to see whether a position was bought or sold, the size of the trade, the expiration, the strike price, the price it traded at, whether it was opening or closing, and the market at the time of the trade, along with where the stock was trading at the time of the trade. So all of this gives us interesting insights into what the traders' motivations are for this trade. Now, what do we see right here on the screen right now? 10,477 of the McDonald's weekly 128 calls were bought for 66 cents. This trade hit the tape on July 19th. So how many days did this trader have left before these options expired? How many days did they have left before the position rolls off and expiry happens? 10 days, right? Pretty short time frame. Also, the stock is trading below 125, and they're buying the 128 calls. So their break even is almost $4 higher than where the stock is trading right now. And they're coming in and risking a pretty large amount of capital here. This is almost a $700,000 bet by this institutional trader. Now, let me ask you guys this. If someone's coming in and placing a $700,000 bet that expires in 10 days, do you think that they're pretty confident? Is there a high level of conviction behind this trade from this institutional trader? They think the stock's going to move pretty darn quickly, right? They don't think that this is going to be a move that takes place slowly and gradually over the next 10 days, because they're coming in and buying aggressively short-dated options and putting a big chunk of capital behind this position, right? So let's see what happens. As soon as they buy these calls, the stock starts to rip higher. And by the end of the day, they traded as high as $1.41, doubling in value, more than doubling in value. A trader that would have bought a 20 lot of these would have been up $1,500 at the highs in a matter of hours by following this unusual options activity. So you guys all see how that works there? A big, enormous order hits the tape. Big institutional trader makes a large bet using short-dated, aggressive, out-of-the-money calls in McDonald's. As soon as the bet hits the tape, the stock takes off and rallies into the close, right? This is how we trade like hedge fund managers, by taking the same trades that they are taking. Now, it's not all that simple. It's not just a matter of looking at the tape and taking every single large block trade that comes across. We're going to talk a little bit more about this as we get further into this. But this is the exact type of setup that I'm looking for. A big, huge bet with a lot of institutional money behind it in short-dated options or in more medium-term options. We're going to talk about that as well. Here's another example also from last week. So this trade hit the tape on Monday, about 40 minutes after the open in ANF. And here we have, again, short-dated weekly options for Aug 12th expiry, trading for 63 cents. Trader comes in and buys 5,067 of these weekly 20-strike calls for 63 cents, betting a little over $320,000 that ANF rallies above that level by expiration. $319,000 bet. And in the following days, the stock rips to the upside. After they buy these calls trade as high as 98 cents in that same session meaning that a trader that would have taken this position would have experienced a 50% profit in a matter of hours. I don't know how to replicate something like that using stock. It's very, very difficult to do. Right now, these options are trading even higher. The stock is at 2070 right now, and the AUG 12th weekly expiration 20 strike calls are $1 at 107 as of Friday's close, right? That is a huge, huge, huge return in a very short amount of time in these options. We also know that these things have traded north of 21 since then as well. So the trader that bought these has experienced massive, massive profits. Now, these are all day trade examples that we just went over, how I can use unusual options activity to capture really fast, really aggressive types of moves like this. But that's not for everybody. How many of you in here would say that you wouldn't consider yourselves day traders at all? That you would consider yourselves more of a swing trader or more of a longer term type of investor or trader? You're not really looking for big intraday moves. You're looking for something that's a little bit slower. Well, unusual options activity is going to help me do that as well. Some setups are better for day trades and some are better for swing trades. What's great about following unusual options activity and institutional order flow is that all of these orders are going to come in along different time frames because hedge funds do it all, right? They trade really short dated options for moves over a couple of days or an intraday move. They trade long dated options for moves that are expected to be a little bit more gradual or take a little bit more time to develop, right? So this is something that I can use regardless of what type of trader I am. If I'm not a day trader, that's fine. If I'm a swing trader, that's fine too. I'm going to be able to glean important information off of the order flow that we see. And this is one of the best examples of kind of the longer dated type of move that they play with unusual options activity. This order hit the tape in the middle of the day against open interest of only 319 contracts. Trader came in and bought 14,726 of the PMCS Jan 7 strike calls. Now, this actually happened in October of last year, but I continue to use this example because it's such a good example of how institutional order flow can lead to some unreal home run style type profits when following unusual options activity. Trader came in and bets $1.25 million that PMCS rallies above $7 by January 2016 expiration. Watch what happens to the stock 2 days later. An announcement is made. The stock's going to be acquired in an all-cash deal. The stock gaps to the upside. In that same session, they trade 333, meaning that the trader that did this trade was up 3.6 million in 2 days. A trader that did a 20 lot would have made $4,900 in 2 days, and those options ended up trading as high as 470 before expiration. Now, let me ask you guys a question. And I think I probably know what your answer is going to be already. But do you guys think that this trader that did this trade in PMCS, the institutional trader that came in and executed this order, did they get lucky or did they know that something was going to happen? Is this the luckiest guy in the world or did he have some piece of insider information? What do you think? Yeah, it seems pretty apparent that he knew something, right? It's hard to get lucky like that. But this type of thing happens all of the time. And it happens way more often than the news would lead you to believe. We hear stories and reports about people that are getting in trouble and getting convicted, paying fines for insider trading, but that is only a fraction of what's actually going on out there. A study was done about 2 years ago, and Andrew Ross Sorkin actually wrote and spoke about it pretty extensively. And these market researchers looked at the equity options market and then looked at merger and acquisition deals and said, okay, we want to figure out whether or not options activity can give us a heads up on when there's going to be a merger announcement, or basically how often is there suspicious activity ahead of a big announcement that we shouldn't see activity ahead of because it should be kind of secret, right? And they figured out that between 25 and 30% of all M&A deals that happen in a year have this type of activity ahead of them in one form or another in the equity options market. So think about how many deals happen in a year. A ton, right? That tells me that 1/4 of the time, at least, there is some type of activity like this in the equity options market leading to a big upside move like that. Personally, to me, I've caught moves like this about 5 times in the last like 4 years or so. About 5 times. Some of the best profits I've ever had were from unusual options activity that I got into ahead of a big takeout like that, right? I can think of a couple off the top of my head. We have traders that were able to get into Kraft ahead of the big Heinz merger. There was incredibly obvious unusual options activity ahead of those announcements. But this is why we want to take these trades, right? This is the reason that we want to look at unusual options activity, because hedge funds and institutional traders simply have more information than us. They have more information because of their position, because of the capital that they have. They have better ways to analyze the public information that's available to all of us. So even if they don't have insider info, the public sphere of knowledge that's out there, the public sphere of information, they get more info out of that. They're able to extract more value out of that because they have more manpower than us, right? We can read research papers, we can read newsletters, but that's not going to put us in the same place as a hedge fund is, because they have so many people working on an idea before they actually go ahead and place that trade, right? It's pretty incredible to think about, right? It's pretty incredible to think about. So what we need to do is find a way to compete with them. How can we play on the same level as these institutional traders? And this is where unusual options activity comes into play, right? A trader that is following unusual options activity is essentially looking over the shoulder of the hedge fund manager and seeing what it is that they're doing with their risk capital. And I always put this in here because someone always asks me this question. If I am following a trade that is being conducted, like in PMCS, by someone that has insider information, am I doing something wrong? Is there something that is illegal or wrong about that? And the answer is absolutely not. As soon as a trade hits the tape, it becomes public information. And a trader that is following that can do anything they want with that information. So all I have to do is pay attention to the tape, find suspicious or large orders, and I can get myself into positions like the examples that we just looked over. This week, we had a really good example of unusual options activity in Yandex ahead of earnings. Yandex saw some very interesting UOA right ahead of the earnings announcement that took place this week, and I'm going to show it to you right now. So what we saw was a trader coming in and buying big blocks of the Yandex AUG22 calls with only about 45 minutes left to go in the trading day, right? That is pretty aggressive activity. After they came in and bought those Yandex calls, the stock ripped to the upside, absolutely ripped to the upside. And what we can see is that a trader that would have been paying attention to that order would have been able to catch a pretty aggressive move into the close, and an even more aggressive move the next day after the stock reported earnings. These options that this trader bought for 85 cents ended up trading as high. Let me pull up a chart of the option here. Ended up trading as high as $1.55 into the next day, right? Now I ask you again, did this trader put on this trade with the knowledge that Yandex was going to have a pretty good number? Or did they just have a good read on the situation based on the information analysis that they were able to do? It doesn't really matter to me. I was able to take this trade and make a quick $500 at the end of the day in Yandex, the day that these options hit the tape. And that's exactly what I'm trying to do. Get into moves, get into positions ahead of the big amount of pressure that comes out right before, the earnings, right before the announcement, right before the move in the stock. Okay. Now, it's a little bit more complicated than just grabbing every large order off the tape. We do need to have a trading plan to figure out which orders are going to be the highest probability for a move. But before we jump into that, does anyone have any questions so far? Does anyone have any questions thus far? Anything at all? I don't want to jump into the trading plan itself if we're still kind of confused on the concept of unusual options activity or the concept of following institutional order flow. Cool. So how do I take advantage of this? This is all good information, right? It's all really interesting to see how much options activity can predict a move in the stock, right? Someone says, when it hits, does it move away too fast to miss it? So, Kevin, if I'm going to be looking at day trades, sometimes it happens pretty quickly, right? That example in ANF, that example in McDonald's, that moved pretty fast. I can't take 20 minutes to figure out what it is I'm going to do in the position if it's a short dated option like that, right? Some of my best trades and my favorite setups are options that hit the tape into the close like on Thursday for expiration the next day. Because that's a bet that a trader is making with an expectation that the move happens really fast. If I'm really worried about being too slow, then I need to focus a little bit more on some of the longer dated order flow. So think about that. If a trader comes in from a hedge fund and buys big block of weekly options, they're buying short dated options because they're saying, hey, the move's going to happen soon and I want to have the best potential exposure to that with the best ROI, and the short dated options are going to be the cheapest and give me the best potential return on my money. Those are going to be quick. Those are going to be much quicker. If a trader comes in and says, hey, you know what? I'm going to buy a humongous block of October calls because I think between now and then there's going to be a big move in the stock. Well, they're probably not expecting it to happen right now or even the next day or even the next week. So those, I don't have to be quite as fast. I can take a little more time to do some consideration there, right? Does that make sense? Does that make sense to everybody? That was a really good question. Thank you very much for asking that. Does that make sense to everybody? So that's what's great about unusual options activity is you can tailor it to yourself, right? If I don't like to make gun-to-head decisions really quickly like that, then I don't have to. I can focus more on the order flow that's a little bit more long dated. And Kevin now saying, how do I know if it's a new opening position or if they're covering an old position? Fantastic question. You're asking like all the right questions. I'm going to get to that in 1 second because that's an important part of the plan. How do I take advantage of this? I have to have a trading plan in place. I need to know a couple of things. I need to know whether or not the bet is a speculative bet or a hedge. I don't want to trade hedges because they're not expecting those options to be worth more. They want them to be worth less. They have an underlying position. And I need to make sure that I'm in opening positions only. I don't want to get into a trade as a trader is getting out of it, right? So I need to make sure that probability is on my side as well. We've developed a plan to address that, and we call it the Oak Ribbit Trading Plan. And it's not the most eloquent name for a plan. It is an acronym. If you have any better suggestions, please, I am all ears. But this is easy to remember, which is why we like it. And it stands for all of the points of analysis that I should be doing when I see an order hitting the tape. The first one addresses your question, Kevin. Open interest, chart, risk, reward, break-even time, and target. All of these things help me figure out whether or not a position is something I should actually be getting involved in, or if it's just noise on the tape that I should avoid, okay? The first thing that I want to do is determine whether or not a position is opening. Most places that you can get this information from, this piece of software, Thinkorswim, will have a tag if a trade is an opening position. They will label it as such. The exchange is supposed to do that. That doesn't always happen, but there's one really, really easy way to guarantee with 100% certainty that it's not a cover of an old position, but an opening position. And that's to look at volume and open interest. Here we can see that the volume in this trade is 10,477. The open interest was much, much smaller when this order hit the tape. It was only 155 contracts. So I know for sure, see there's the open interest, that this is an opening position, right? If they're buying almost 11,000 contracts and there isn't 11,000 open for them to cover, it can't be closing. There isn't open interest there for them to close. Right? So as long as volume is greater than open interest, it's guaranteed to be an opening position, right? Super simple way to determine that with certainty. You see that? Does everyone see that? Kevin, does that answer your question? So if I ever see an order where the volume is less than open interest, then I can't say for sure whether or not it's an opening position or if it's a trader covering an existing position and exiting it. And if that's the case, then I'm done. I move on to the next alert. I don't need to pay attention to this one anymore. Okay? So this is this is a really easy way to make that determination and show with certainty that this is an opening position. So once that's done, I need to figure out whether or not the trade is more likely to be a speculative bet or a hedge, and I use the chart to do that. So the Ichimoku Cloud is a technical setup that we use, a technical indicator that we use to determine whether or not the stock is in bullish or bearish territory. And it's really simple and easy to read. All I have to do is look at the cloud itself and determine whether or not it's in bullish territory, bearish territory, or neutral territory. If I see calls being bought, I want the stock to be in bullish territory. If I see puts being bought, I want it to be in bearish territory. In the index, when that order hit the tape, the stock was firmly in bullish territory. It was above the cloud. Okay? That's as simple as it is. With short-dated options, it's a little bit easier. With long-dated options, I wouldn't look at the 5-minute bar. I would look at the daily bar. And even then, this was still a pretty bullish-looking chart. I don't want to trade against the trend because if I'm doing that, it's more likely that the institutional trader is buying a hedge, right? If I see a stock making new 52-week highs and I see an enormous block of puts being bought, what does that tell me? That tells me that the trader probably isn't looking to get short at that level. Institutions don't really trade against trend like that, right? They're more likely already long the stock and are buying puts against it, okay? So after I make that determination, I want to make sure that I can take this trade in size that will allow me to scale out. Now this says, can I take at least a 20 lot? Really, for anyone with a smaller account, the question is, can I take at least a 4 lot? And the reason I want to take at least 4 contracts is because I want to take at least 4 profit targets. I don't want to buy them, hold them, and sell them 10 cents higher. That's not a very good risk versus reward ratio that I'm putting myself into. I want to be able to scale out of a position. And if I can take at least 4 contracts without violating whatever rule I set as the maximum percentage of my book to be in one trade, for me that's 5%. For you it might be 7, it might be 3. It might be something else. You have to determine that for yourself. I want to be able to scale out of the trade if that is a position that I think is interesting, okay? After I make that determination and I know how much I can make, I know how much I can lose, I want to make sure that I stick to the trader's position as closely as I possibly can, okay? If I do not do that, I am basically flying completely against everything that I thought was good about this order and about unusual options activity. We just spent a very long time talking about why the institutions have more valuable information than us. Why is it that they are able to do well when the vast majority of retail traders are not? And it all has to do with the advantages that they have. So if I know that they're coming in with more information than me, and sometimes insider information that I don't even want to have myself, why would I ever want to change the trade that they're doing? A good example of this is, and I hear people that are first starting out with trading unusual options activity doing this all the time. They come in and buy October dated options that are on the 100 strike calls. Trader looks at the options chain and says, you know what, I can buy the August options on the 105 line for 10% as much. Why wouldn't I just do those? They're expecting the stock to move. But when a trader comes in and buys a particular contract, it's after a ton of research and analysis that hedge fund does. Why would I want to say, oh, you know what, you did all that work, I'm just going to do something different. I need to trade the exact same contract. If I see them getting out of the position, I'm going to want to do the same thing as well. That's what's great about tracking UOA as well, is that it'll help me find an exit. If I see an enormous block of calls being bought and it inflates open interest to a huge level on a line, all I have to do is pay attention to that contract from now until the time it expires to see if they get out. And if they get out, then I want to get out too, because they're basically saying that the move is over with. So unusual option activity doesn't only help with entries, it helps with exits as well. Sometimes I'll be in a long position in a stock, and I'll see a trader come in and buy an enormous block of puts, and I'll say, whoa, someone's expecting some downside here. I should probably think about exiting my long. And these are all things that UOA helps me do. It's really important to follow that type of activity, okay? So I want to take questions from you guys. I think I only have about 10 minutes left here or so. But before I do, I want to talk a little bit about what some of our customers have had to say about trading unusual options activity with us. Trevor said, wanted to thank you. When I started, I was down 50% on a $60,000 trading account. As of today, my account is up 5%. It's a $30,000 swing in 2 to 3 months. The last 2 weeks, I'm up over 10 grand, never risking more than 2 grand in any one trade. It's a lot more fun to trade when you are making money and understand how. Matt says, as a new options trader, I lucked into a seminar about UOA in August. My first week generated over $1,000 in profit, and just yesterday, one trade delivered over $2,000 in profit. Steve said UOA helps to stay in a trade and maximize profits, helps on reversals, and this is just our first day. Wish I had this 29 years ago. Your team deserves a kudos. So I have a offer for you guys here. And we actually have a workshop that we put together on how to trade unusual option activity. We really only touched the surface of what it is you need to know to do this effectively. And this course is good for any trader, a beginner, intermediate, or expert skill level, anyone who wants to learn how to trade alongside the biggest and brightest institutional traders in the world, and any traders who want to actually learn and stop guessing for their trade setups. We only have a certain number of spots at this price, and this is a brand new course that we just put together this year. This is a really fantastic thing that we've got for you guys. And not only do we have a workshop for you, but we also have access to our scanner called Option Hacker that gives you all of this order flow information. I saw a lot of questions on, hey, where do I actually get this data? Well, we're going to show you how. We're going to give you access to our completely new and updated Unusual Options Activity Master Course. It is a comprehensive guide to trading unusual options activity. It's going to have an A to Z plan for managing entries, exits, and stop losses in UOA setups, how to understand every single order that comes across the tape so you'd never be confused. You're going to learn Andrew's bread and butter trading plan for trading UOA. Andrew is our head trader and founder and CEO of our firm. I also use this exact same trading plan, but the real value here is that you get 1 month access to our unusual options activity scanner called Option Hacker, which is a $299 value, and it includes a ton of extra stuff along with that, a blueprint, a cheat sheet, and a trading plan, so you know exactly how to read the signals on Option Hacker. Now, I'd show you what it looks like live, but obviously it's a Saturday and the market is not open. So I'll show you what the alerts look like on Option Hacker here. This is a summary email. We take 2,500 orders that hit the tape during the day and boil it down to just 15 to 25 signals that I can then use to find the best possible setups based on unusual options activity. And this is exactly what it looks like. They are spit out in a web-based window, so you can use this regardless of what your trading platform is, and you get all of that information that you need. It labels it as a possible day trade or swing trade setup, whether it's bullish or bearish, and gives you everything you need to know. It also only shows us opening orders. We spent a very long time on the algorithm that filters out all of these trades and gives us this information. I honestly don't remember how I traded before Option Hacker. I absolutely love this thing and use it every single day. Do we have a package for swing traders? Yeah, this is it. This is it. This is something that you can use whether or not you're a day trader, a swing trader, or a longer-term investor, because hedge funds trade options along all of those time frames. We have Option Hacker separating day trade and swing trade setups, so you know exactly what they are when they hit the tape, and then you can do the analysis that the workshop teaches you how to do to use those alerts to your advantage, leverage them in your trading plan. I use unusual options activity every single day. I think it's the best way to day trade options. If you day trade options or stock, then you absolutely need to learn how to read unusual options activity. Not only can this be used for those of you that are trading options, you can use it to trade stock as well. Most people don't think about that. We actually have a trading plan included with Option Hacker, and it's a video that's about an hour long, that shows you how to use these signals to trade stock as well. No, you get the unusual option activity from the scanner. So this is what it looks like. It's not going to be spitting out orders right now because the market is closed and it's Saturday. But what you get is this web-based window. You get to log in and password to this. During the day, during the trading day, this spits out alerts that look exactly like the one in McDonald's that we just saw, makes a sound. You can turn the sound off if you want. Makes a sound and shows you everything you need to know about the trade. Then all of this stuff that we have here in this workshop, the workshop itself is 3 hours long, is going to teach you exactly how to take those signals and apply them to your trading plan. Does this include or use a money flow to go with options in those buying blocks straight up? I guess I'm not really sure I understand your question, William. So when an alert hits Option Hacker, that is a big block of options that is being bought. It's a trade that is happening right now. It works in real time. It works in real time. How long is the service good for? So you get 1 month access to the Option Hacker scanner. After that, it does not renew at full price. So no, you do not have to pay $2.99 after that. I believe it renews at $1.99. So you do get a discount after that, but you're under no obligation whatsoever to continue on with the service. If you don't want to use Option Hacker, just let us know, and that's it. How many swing trade opportunities does the trade Option Hacker see a month? I don't know about how many a month, but for example, you know, on Friday there was only one trade that was able to swing trade that hit the tape. That's pretty uncommon. You usually see a nice balance. If I take a look at any other day this week, let's just grab another day at random. This is Thursday. On Thursday, the trade summary shows me that Option Hacker spit out about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, about 17 trade alerts that had swing trade timeframes. And now, I'm not going to say that every single trade that hits Option Hacker is a winner. It still requires me to do some analysis after it hits. It's just alerting me to that block trade that's happening. I then need to go confirm that using the methods that we discuss in this workshop as well. How long has this tool been available? We've had Option Hacker out for probably about 2.5 years now, maybe a little less than that. It took us quite a while to develop. We spent a very long time kind of honing in on the orders that we wanted, and teaching a computer to read the tape like a human does was not all that easy. What is the average number of contracts per trade? I'm not really sure what you mean by that. We're looking for big block trades, right? So I'm looking for enormous size hitting the tape. Then I can trade that with as many contracts as I want. If I want to trade a 1 lot or a 1,000 lot, it doesn't really matter. It's not something that you need a certain amount of capital to do. I'm just looking for institutional hints on where the market is going at any given time. Have we had to tune the algorithm since inception? Yes, yeah, we've changed it. We've changed it quite a bit. We update it pretty often. Yeah, we update it pretty darn often because we understand, the market's dynamic. Anyone that says that they developed something 15 years ago and haven't changed it since probably shouldn't be using it anymore, right? Even over the last couple of years, I can think of probably about 6 different times where we didn't do a complete tear down and rebuild of what the algorithm was looking for, but tweaked it to kind of give us better looks at what was going on. And we also have updated and added features to it several times. So that is something that everyone gets access to once we do it. If we add something to it, you get access to it right away. All right, so I only have about a minute and a half left here. So any other questions that you guys might have, please feel free to ask now. I probably have time to answer one more question here. How do I use this for spreads? Yeah, I can use it to set up spreads. So what I like to do sometimes is if I see a big block of options hitting the tape ahead of earnings or something like in Yandex, then I can use that to set up a spread going into the catalyst. But typically speaking, I'm more of a day trader than I am a swing trader, so I use them for day trade signals where I'm buying the outrights, flipping out of them after the move happens, and then going home with no position on. But I've had a couple of good swing trades this week even that I picked up off Option Hacker. It's really, really great for both. If you're a swing trader, then don't think that this isn't for you. It's for everyone. All right. So any other questions, guys? Any other questions? Any other questions? I think I have about another minute left here. Do I both buy and sell options? Typically, I buy options. I'm not typically selling premium. The thing is, with the VIX at the levels that it's at now, I don't really think that there's really that much opportunity to sell premium. If that flips around, then I look for opportunities to sell premium. But for the most part, this is something that I'm using to buy options. It's very difficult to tell what a trader's underlying intent is when they're selling big blocks of options. They might be doing a vol play. When they're buying directional plays, it's a lot easier to kind of suss out what it is the institutional trader is doing. You just order it, look forward to it. Cool, Kevin. I think you're going to love it. You'll have the rest of the weekend to go through the workshop and all the supplemental materials, and you'll fly into Monday's Open ready to trade unusual option activity. Yeah, to be honest, the scanner in Thinkorswim isn't really all that great. I would say that this is something that's going to work in real time and work a whole lot better for you. All right, so I think that brings me to the end of my time here. Michael, I can't really copy your email out of here. If you want to shoot me an email, james@alphashark.com, I will be able to send you the link afterwards and hold a spot for you. Yeah, you can log into it right now if you want to. It's just not going to be spitting anything out because the um, the market's closed. Alrighty, so I think that's the end for me here. Yeah.